Okay, so this is the fourth class of equity valuation under SFM Dawn series. If you remember, we have completed economic value added, Alker model, dividend discount model, price earnings or price to sales ratio approach. We have also done a good sum on equity beta, asset beta, debt beta. So in this class, I propose to do three things. Accounting based valuation, very easy but then important. Certain sums on buyback, which is related to DDM, and certain sums on rights issue, a very odd topic which people forget to prepare. So accounting based valuation, rights issue, and buyback. Maybe I'll also touch upon sums on bonus issue. Okay, so let's see how much we can sustain in this class. So I'm going to the sheet, just 1 second. Yeah, here you have. So I'm coming to the accounting based valuation, question number 10. So here you have question number 10. Now as you can see, this sum was done in class. So there is nothing new in this sum. We shouldn't be spending or wasting time on it, but I'm just taking you through this sum. In this sum, the first question is saying prepare the income statement for the year 31st March 2020. So income statement. Now asset turnover ratio 1.1 is given, asset 600 is given. So sales become 660 crores. Operating margin 10% is given. So operating profit becomes 660 into 10%, 66 crores. Million, sorry. 660 into 10%, 66 million. Next we require interest because we got the EBIT, we require interest. Now there is a confusion because interest can be calculated in two ways. One is if you can see 8% of 125 plus 10% of 50 because debentures and bonds are given. But the other is the effective interest rate is given. So 8% of 175. The two figures are not tallying. Since it's a repeated sum multiple times, Institute has done 8% of 175 and you're supposed to remember which is 14. So from 66 we deduct 14. So 66 minus 14 gives us the pre-tax profit PBT which is 52. Okay, now in this class a student is sitting by my side, so he's doing the calculation, I don't have to. So 52 is the PBT. Now what's the tax rate? The tax rate is 40%, so 52 into 0.6. 52 into 0.6 is the PAT, 31.2. 31.2 is the PAT, and what's the payout ratio? 16.67%. So 31.2 into 16.67%. 31.2 into 16.67%, that is 5.2. So 5.2 is the dividend. So retained earning is 31.2 minus 5.2. Retained earning is 31.2 minus 5.2, which is 26. That's the income statement. Okay. So income statement. Let's see. Yes, here we have the income statement. 26 retained earning. Perfect. Okay. Second, calculate the sustainable growth rates. That's G equal to B into R. So B is the retention ratio. Since payout ratio is 16.67, retention ratio is 83.33. Okay, and what's the ROE? We got the PAT. What PAT did we get? 31.2, I think. Yeah, we got 31.2 PAT. And what is the net worth? The net worth, if you see, is share capital 100, reserves 300, so 400. So the PAT is 31.2 and net worth is 400. 31.2 by 400. What's the ROE? 31.2 by 400. ROE in percentage. 31.2 by 400. What is the ROE? It is 7.8%. So ROE is 7.8% and retention ratio is 83.33%. So G equal to B into R. 0.8333 into 7.8. 0.8333 into 7.8 comes to 6.5%. Sustainable growth rate is 6.5%. G equal to B into R. Find out the fair price of the share using DDM. So fair price of the share will be D1 divided by RE minus G. So the dividend was 5.2 crores and the number of shares is 10 crores. So 5.2 by 10. D0 is 0.52. D0 is 0.52. The growth was 6.5. So D1 is 0.52 into 1.065. 0.52 is D0 into 1 plus G. So 0.52 into 1.065. That's 0.55 approx is the D1. And that divided by RE minus G. RE is 15% and G is 6.5. So D1 by RE minus G, you calculate the value of the share. Here you have the answer in case the figures were difficult for you. Okay, 0.52 into 1.065 divided by RE minus G. The answer comes to 6.52. I don't know why they have done it twice. Oh, they have calculated two sustainable growth rates. I don't know what's happening, whatever. So that's the value of the share, D1 by RE minus G. And in the last part of the question, advise whether the share is underpriced or overpriced. So when the intrinsic value of the share is what? 6.91 is the intrinsic value, whereas the share price is 14. So the share is overpriced. We should not buy. The share is overpriced. We should not buy the share. It's overpriced. This question has been done in class. It is not a new question. No complaints about this. It can come in the exam. Okay. Next, let's move to another sum, accounting based valuation. We are moving to another sum on accounting based valuation. Now this is question number 11. So question number 11, this sum has also been done in class. Excellent Limited reported a profit of 154 lakhs after 30% tax for the financial year 1920. An analysis of the accounts revealed that there is an extraordinary loss of 20 and extraordinary income of 16. So you understand what we have to do. We have to find out the sustainable earnings. So first of all, we make the 154 pre-tax. 154 divided by 0.7. That's 220 lakhs is the PBT. And in the PBT, we add 4 lakhs. 20 minus 16, 4 lakhs. Okay. Added back. So we add 4 lakhs, 224 lakhs is the sustainable PBT. 224 lakhs. Okay. That is from existing operations. Now, a new product is being launched and sales minus material cost minus labor cost minus fixed cost. Let's do that. So that's coming to what? I think that's coming to 56. 56 is the profit from the new product. 224 was existing. So 224 plus 56. 224 plus 56 is 280. And 280. And what's the tax rate? 30%. So 280 into 0.7 is 196. 196 is the after-tax profit. Calculate the value of the business given the capitalization rate of 14%. So 196 divided by 0.14. Okay, value of the business is sustainable earnings divided by capitalization rate. 196 by 0.14. 1400 answer. 1400 lakhs is the value of the business. 1400 lakhs. Under the accounting based approach, value of business is equal to sustainable earnings divided by cap rate. So 196 by 0.14. 1400. Let's check the answer. Yes, it's 1400 lakhs. Now the second part of the question. Determine the market price of the share. With Excellent Limited's share capital comprising of 2 lakh 13% preference shares of 100 each and 100 lakh equity shares of 10 each, and P ratio is 12 times. P ratio is given. So share price will be P ratio into EPS. So let's try to find out the EPS. We already computed the PAT at 196 if you remember. PAT was 196. So 196 minus preference dividend. Preference dividend is 13 into 2, that is 26 lakhs. So 196 minus 26. 196 minus 26 is 170 lakhs. That's Natesh or Pafish. You all call it, I think, Pafish. I call it equity earnings. But you have the habit from C Enter calling it profit available for equity shareholder, Pafish. Okay, I call it equity earnings. So equity earnings is 170 lakhs. And how many shares do we have? Equity shares 100. So 170 by 100. So EPS is 1.7. EPS is 1.7. P ratio 12. 1.7 into 12. 1.7 into 12. What is it? 20.4. 20.4 is the share price. 20.4. Both these sums, although I have done, there is no question of anybody thinking that sir is doing fast, because these are sums already done in class. You would wish me to do it fast so that your time doesn't get wasted. Okay, let's move to the next series of questions. I am now going to move into rights issue. Okay, question number 14. Rights issue. Do you want me to revise the rights issue for you? Let me do that. Okay. Rights issue is a very easy topic, but people tend to forget about it. Now, if we know that if a company's share is trading at P0, say 100, rights issue takes place at a lower price, say X equal to 60. So existing shareholders get the right to apply for the company shares at a lower price, that is 60. Now suppose the rights ratio is 1:2. That means for every 2 shares you get 1 share. So in that case, the theoretical X rights price, if I call it PE, is the weighted average of 160. It is 2 into 100 plus X, 2 into 100 plus 1 into 60. 2 into 100 plus 1 into 60. The whole divided by 2 plus 1. Okay, 2 into 100 plus 1 into 60. The whole divided by 2 plus 1. This is coming to 86.67. This is the theoretical X rights price. It is the weighted average of the cum rights price and the rights issue price. Okay, 2 is the weight for the cum rights price and 1 is the weight for the X rights price. Now, since this is the theoretical X rights price, if we are asked to find out the value of the right, okay, you renounce the call option to somebody else, the value of the right should be 86.67, that is PE, minus 60, which is 26.67. Sometimes they accept the answer 26.67, but sometimes they divide it by 2, because in order to apply for the right, you got to have 2 shares, na? You got to have 2 shares, so it becomes 13.33. So value of the right, both are correct. This is also correct, this is also correct. Okay, I advise you to give 2 answers. Okay, so this is basically what we do. And when a person gets a rights offer, he can do 3 things: either apply for the shares, sensible thing, or renounce your rights, sell your rights to somebody else, sensible thing. If you do the sensible things, your wealth will remain the same. But if you do not do anything, you just sleep at home, in that case your wealth will be eroded. Okay, that's the rights issue. I've done it very fast. Don't mind it, it's an accounting topic anyways. Let's get to the question. Aggressive Limited is proposing to fund its expansion plan of 12 crores by making a rights issue. So they are going to require 12 crores for expansion. Current market price is 40. Board is willing to offer a discount of 20% on the current market price for the rights issue. So the rights issue will be at 32. So P0 is 40 and X is 32. Correct? So we can find out the number of shares to be issued, because you want to raise 12 crores at 32. So 12 crores by 32. 12 crores by 32 is 3,75,000 shares. That's third part, 3,75,000 shares. The third part answer, the total number of shares to be issued. The third part, we've got 3,75,000 shares. Board is willing to offer a discount, that's okay. Board is also desirous that the fall in the X rights price is restricted to 10% of the current market price. So which means 40 into 0.9, 36 is PE. 36 is PE. We know P0 is 40. We know X is what? 32, and we know PE 36 lies in between. That means the rights ratio will be 1:1. You are required to calculate the number of new equity shares to be offered. 1:1. Theoretical value of the right. Theoretical value of the right will be 36 minus 32, which is 4. 36 minus 32, that is 4. Let's come to the next question. Rights issue. Do we have another sum? Yes. Question number 17. Amco Limited has 75,000 equity shares of 10 each. Okay, these are when the company started, 75,000 shares were issued at 10 each. The current market price is 36 P0, cum rights price. Company has a plan to make a rights issue of 1 share at the rate of 24 for 4 shares held 1:4 at 24. 24 is X. Calculate the theoretical post rights price. So 4 into 36 plus 1 into 24 divided by 5. 4 into 36 plus 1 into 24 divided by 5, 33.6 weighted average. Okay, calculate the value of the right alone. So 33.6 minus 24, 33.6 minus 24, 9.6 is one of the answers, or 9.6 by 4. 9.6 by 4 is 2.4. So both answers should be given. Check 33.6 and then 9.6 or 2.4. 9.6 is the value of the right of applying for 1 share, and 2.4 is the value of the right by virtue of having 1 share. You got to have 4 shares na, to apply for 1 share, to divide by 4, 2.4. That's rights issue, nothing conceptual about it. But when it comes in the exam, these are precious marks, which can be a difference between your getting a 90, 80 or getting an aggregate, or getting a rank, not getting a rank. So pay attention to each and every petty thing or difficult thing that is being done. Okay, perfect. So rights issue is over. Let's do buyback. So question number 12 is on buyback. SK Limited has surplus cash of 150 lakhs and wants to distribute 30% to shareholders. So 150 lakh, 30%, which 45 lakhs they want to distribute. So they can either pay dividend or they can go for buyback. Company decided to go for buyback. Okay, they'll go for buyback. 45 lakh buyback. Company estimates the share price after buyback will be 15% above the buyback price. Now this is very difficult to say. We are thankful that they have mentioned whatever price you buy back, say X, the price after buyback will be 15% higher, 1.15x. Number of shares outstanding at present is 15 lakhs and EPS is 4. So PAT is 60 lakhs. PAT is 60 lakhs. Calculate the price at which shares can be bought back if the market cap of the company should be 400 lakhs after the buyback. So many times we have done it in class. Let the buyback price be what? X. So the number of shares bought back is 45 by X. You remember? We had 150 lakh surplus, out of which 30%, 45 lakh we want to use it for buyback. So number of shares remaining will be 15 minus 45 by X. And the share price after buyback will be 1.15x. So number of shares into market price should be 400 lakhs market cap. Solve for X. Of course you can do it, please. Solve for X. Okay. The number of shares that can be bought back. So 45 by X. Impact of buyback on EPS, assuming net income remains the same. So net income was 60. So 60 will remain 60. You have to divide by the remaining shares, which is 15 minus 45 by X. Okay. Don't mind it, but there's no question of slowing it down. It's good that you are doing it in 2 minutes. You will feel you would have spent the same time in doing it yourself. Perfect. So let's move to the next question on buyback. The next question on buyback is question number 18. Eager Limited has a market cap of 1500 crores. The sum recently came in the exam. Commonsensical sum. Eager has a market cap of 1500 crores and the current market price of the share is 1500. So that means number of shares 1 crore. Number of shares 1 crore. I'm going to do it verbally. It has a PAT of 200 crore. So that means EPS is also 200. 200 by 1. EPS is 200 in case we require. Board is considering a proposal to buy back 20% shares. So 0.2 crore shares will be bought back. 0.8 crore shares remaining after buyback. At a premium of 10% to the current price. The current price was 1500. So buyback price is 1500, 10% higher, 1650. 1650. So the amount required for buyback is 0.2 into 1650. Amount required for buyback is 0.2 into 1650, which is 330. 330 crores is the amount required for buyback. It plans to fund this via bank loan at 16%. So 330, 16%. 330 into 16% is the interest expense. 52.8 crore is the interest expense. You are required to calculate the post buyback EPS tax rate 30%. This is damn easy. 1 second. So EPS will be the PAT, which was I think 200 minus the post tax interest 51.8. Was it 51.8? Yes. Into the point, what was the tax rate? 30%. So 51.8 into, it was 52.8. Sorry. Interest was 52.8. So 52.8 into 0.7. I've deducted the post-tax interest. You want to do time pass? You can make the 200 pre-tax, then deduct 52.8, then make the whole thing post-tax. But instead I have done PAT minus post-tax interest. The whole divided by number of shares 0.8. The whole divided by number of shares 0.8. It is 203.8 new EPS. 203.8 is the new EPS. Of course, you have to decorate it and all that stuff. Okay. But like old PAT minus the post-tax interest. No, sir, I don't like this. Okay, no issues. You find out the pre-tax profit. Let me do it again. 200 divided by 0.7. This is the pre-tax profit minus 52.8 is the interest. The whole into 0.7, this is the new PAT. The whole divided by 0.8. Okay. Anyways, you do it. Doesn't matter. Okay. 203.8. So that was buyback. So 2 questions on buyback, 2 questions on rights issue, and 2 questions on accounting based valuation. Let's get to the bonus issue stuff. So I think we have one sum on bonus issue because there was one sum on bonus issue, question number 4, which I had done with DDM. Another sum on bonus issue. Let's come to the sum. Good sum. And it's being repeated nowadays. Intel Limited, promoted by a transnational company, is listed on the stock exchange holding 80%. Okay, so the mother company, promoter company has 80% stake. But you know, SEBI guidelines do not allow a company to be listed if the floating stock public doesn't have at least 25%. So the maximum promoter holding is 75%. The sum is based upon that. Okay, so how do you know this? Because I've done this a number of times. You should also, if you are appearing for the exam. Value of the floating stock is 45 crores. That means 20% of the value of market cap is 45 crores because 80% is held by promoters. Floating stock is 20%. So 45 crore is 20%. So 45 by 0.2. 45 divided by 0.2 is what? 225 crore is the total market cap. Market price is 150. So 225 by 150. 225 by 150. 1.5 crore is the total number of shares. You want me to do hole hole? Let me do hole hole. Free float market cap is 45 crore. This represents 20%. Therefore, market cap is 45 by 0.2, which is 225 crore. In case I were to do hole hole, number of shares will be 225 divided by market price per share. Market price per share I think was 150. So it comes to number of shares 1.5 crore shares. I'm just checking. Market price was 150. Yeah, 1.5 crore shares. So out of the 1.5 crore shares, held by promoters 1.2 crore, held by floating as in minority and all, floating 0.3 crore. Perfect. We are perfectly set for the question. Capitalization rate is 20%. Capitalization rate is 20%. So P ratio is 1 by RE. So 1 by 0.2 equal to 5 times. P ratio is 5 times. Okay, P ratio is 5 times. And what's the price? The share price was 150. Share price was 150. So EPS is, what is the EPS? 150 by 5. 150 by 5, which is what? 30. 30 is the EPS. 30 is the EPS and 1.5 crore shares are there. So what is the PAT? 30 into 1.5. PAT is 30 into 1.5, which is 45. 45 crores is the PAT. Okay. Promoters holding is to be restricted to 75% as per SEBI guidelines. The board of directors have decided to fall in line to restrict the promoters holding to 75% by issuing bonus shares to minority shareholders while maintaining the P ratio. Okay. So that means the board of directors, they will issue bonus shares. Now we have 1.2 crore shares and that's got to be 75%. So what is the total number of shares? 1.2 by 0.75, which is 1.6 crore shares minus 1.2. That means 0.4 crore shares will be floating, less existing 0.3 crore. So 0.1 crore bonus shares. 0.1 crore bonus shares. You are required to calculate the bonus ratio. So bonus ratio is 0.1 is to 0.3, which is 1 is to 3. That's the bonus ratio. Calculate the price after bonus ratio. P ratio into EPS. P ratio into EPS. So what's the EPS? EPS will be the PAT 45 crore divided by the number of shares 1.6. What's the EPS? 28.13 is the EPS. 28.13 is the EPS approx, and the P ratio is 5. So share price is approximately 140.63 subject to rounding off. 140.63 price after the bonus issue. Free float market cap after the issue of bonus shares. So that's number of shares of floating stock into price. Number of shares are 0.4 crore. So number of shares floating, N floating is what? 0.4. So we have free float market cap. Free float market cap is 0.5 into this, which is what? 56.25 crores. 56.25 crores is the free float market cap. 56.25 crores answer. Free float market cap. Understood? Free float market cap 56.25 crores. Sum is repeated. I think it's the third time the sum came in the exam. So we have done two sums, accounting based valuation. We have done two sums of buyback, two sums of rights issue, one sum of bonus. Let's do one sum on capital structure. Okay, because capital structure is a CA intermediate topic. Capital structure is a CA intermediate topic. Let's go to capital structure sum. Okay, so here we have capital structure. It means from where to raise funds, debt or equity. Let's see. The following information available for Messrs TS Limited. EBIT 5 crores, less interest 10% to 1 crore. That means debt is 10 crore, 1 by 0.1, debt is 10 crore. Please remember, debt is 10 crore because 1 crore interest at the rate of 10%. PBT 4 crore, less tax 25%, PAT 3 crore, number of shares 40 lakhs. So EPS 7.5, price 75, so P ratio 10 times. TS Limited has undistributed reserves of 8 crore. So the share capital is 40 lakhs into 10, 400 lakhs, 4 crore, and the reserves are 8 crore, 4 crore plus 8 crore. Net worth is 12 crore. Okay, net worth is 12 crore, 4 plus 8. 12 crore is the net worth and 10 crore was the debt. So capital employed is 12 plus 10, 22 crore. Capital employed is 12 plus 10, 22. Company requires 3 crores for the purpose of expansion, which is expected to earn the same rate of return on capital employed as present. So this 3 crore will earn the same ROCE as present. So we have to calculate the present ROCE. Now what is ROCE? ROCE is EBIT divided by capital employed into 100. EBIT by capital employed into 100. So what is the EBIT that we have? I think 5. Let me check it out. EBIT is 5. And capital employed is net worth plus debt. Net worth is share capital plus reserves. Debt is 1 by 0.1 equal to 10. Share capital is 40 lakh shares into 10, which is 400 lakh, that is 4 crores. Reserves is 8 crore. So net worth is 12 crore. 12 crore plus 10 crore. 22 crore is this part. So 5 by 22 into 100, return on capital employed. 5 by 22, which is 22.73%. 22.73%. We will earn this on the 3 crore new funds raised. Yes, please. 22.73% of 3 crores in crore form, not in open form. 3 into 0.2273. 3 into 0.2273. Give me the decimal. In higher decimal, please. 3 into 0.2273 is equal to 0.6819 crores. 0.6819 crore is the extra EBIT. So EBIT in future will be 5.6819. 5 crore is the existing EBIT after the project. 5.6819 crore shall be the future EBIT. However, if the debt to capital employed ratio is higher than 35%, I think it's already higher because we have 10 crore debt and 22 crore capital employed. What's the present debt to capital employed? 10 by 22. It's 45.45%. So they are saying if the debt to capital employed is more than 35%, the P ratio will decline to 8 times. I'm really surprised. I think they have constructed the sum wrong, because if that is true, it is already 45%. So P ratio should not be 10, it should be 8 times. So that's a stupidity in the sum. and rise in the cost of additional debt to 14%. When you raise new debt, it will come at 14%. Okay, because the existing debt is at 10%. That makes sense. Given this data, which of the following options the company would prefer and why? If the required amount is raised through debt, that means the 3 crore is raised via debt, or if the required amount is raised through equity and the new shares will be issued at 25 each. So they are asking which alternative should we go for. Please remember, the objective of financial management is shareholders' wealth maximization. So we will go for that particular alternative which results in the higher share price. And share price will be P ratio into EPS. Okay. So we have to calculate the EPS. So to calculate the EPS, we have the EBIT 5.68125 whatever. So EBIT minus interest, PBT less tax, PAT by number of shares. It's very easy. So we just have to calculate the EPS. If we go for alternative 1, that is debt. So 3 crore debt at 14%. What's the interest? 3 crore debt at 14%. 3 crore debt at 14%. The interest is 0.42. 0.42. Okay, 0.42 is the interest. And we already have interest of 1. So 1 and 0.42. 1.42 is the interest expense. So the PBT comes to 5.6819 minus 1.42, which is 4.2619. And the tax rate was 25%. So 4.2619 into 75%. PAT. This comes to 3.1964. And number of shares was 0.4 crore. Divide by 0.4 crore. So our EPS comes to 7.9911, maybe 8, I don't know. 7.9911, maybe 8. And P ratio would be, we are taking more debt now, already 45% was there, 8 times. P ratio 8 times. So share price would be around 64. Share price would be around 64 under alternative 1. Share price 64. Let me check the answer. Because either I can do some rhythmic mistake or the person sitting by my side may do some calculation mistake. 64, yeah, 63.92. Okay, that's the share price and option 1. And option 2, we have this 5.6819 EBIT. Interest remains at 1 because we are not issuing extra debt. So this is 4.6819 post-tax at the rate of 75%. So PAT is 3.5114. Now the number of shares will go up because we are issuing shares. How much do you want to raise? 3 crore and we are raising at 25. 3 by 25. 3 by 25 is 0.12. So number of shares becomes 0.4 plus 0.12. 0.52. 0.4 crore shares plus 0.12. 0.52. So 3.5114 divided by 0.52 is 6.752. 6.7527 is the EPS, and P ratio is still 8, I think. Why? Because now the equity is 15, 12 plus 3, 15, and debt is 10. So what is 10 by 15? What is 10 by 15? 10 by 15. 10 by 25. 10 by 25. Capital employed is 25 and debt is 10. 10 by 25 is 0.4. It's more than 35%. So P ratio would be 8, not 10. So 8 into 6.7527. The share price comes to around 54. So obviously we should choose alternative 1. This is a sum from capital structure, common sense, out of syllabus. They have the right. They will say that yeah, it is commonsensical. A CS student should know it. That's the capital structure sum. Capital structure. Okay. Perfect. So I'll just record one more class on EFR and that would complete equity, because this class is becoming exhaustive. If I record EFR right now, it will become too exhaustive. I'll record one short class of external funds required. Those who did the SFM English batch with me, we had not done external funds required in class. Why, sir? Why had you not done? Because it's not there in the syllabus. So why are you doing now? Because they set sums on it. So they can set sums on anything on the globe. We'll then understand it is in syllabus. Okay. Okay. So I end the class over here. Thank you.